yet thinking that the product will solve everything and that the sales come automatically. Because it's going to be a hard lesson for them to realize how difficult it is to really get in and make sales to enterprise. Procurement process is not simple.
Hey, and welcome back to another episode of Angels, Exits, and Acquisitions. I'm your host, Jeff Barnes with Angel Investors Network. Really excited to have you here today on this episode of Angels, Exits, and Acquisitions with David Mandel of Emerging Venture Capital. Now, this is a really unique interview because David's done over 500 different investments in emerging startups and technology companies and has a lot of great insight for anyone who is interested in becoming an angel investor, as well as the startups who are pitching to angel investors and venture capital groups. So if that's you, then make sure you watch this whole episode. And as always, give us a thumbs up. Let us know what you thought about the episode. Take care.
Welcome to Angels, Exits, and Acquisitions, the place to learn how to fund, scale, exit, and massively profit as an angel investor or entrepreneur. Brought to you by the Angel Investors Network. And now, here's your host, Jeff Barnes.
All right, welcome back. Jeff Barnes here with another episode of Angels, Exits, and Acquisitions. I'm here today with David Mandel of Emerging Ventures Capital Group. David, how are you today?
Morning, Jeff. Happy to be here.
Thanks so much. I'm really happy to have you here. I know we're going to have a great conversation today about, venture capital, angel investing, how things have changed, and your background. But before we get started, why don't you tell folks a little bit about yourself and your history?
Sure. Thanks, Jeff. I spent most of my life in insurance and finance. Academically, I was a math nerd, math and computer science undergraduate, applied math for graduate work, passed the master comms, got the master's, dropped out of the doctorate program, did not stay on, and decided to go into business. It was kind of the dark ages of AI, so to speak, and of math as applied to computers and so forth. So, I was getting out of school around 1990, 91, and there wasn't a lot of work for math PhDs at the time. So decided to drop out, go into business. That built and exited 4 businesses, including probably second largest non-standard auto insurance underwriter in California, which exited to Kemper in 2014, had a subprime auto lender, which we financed used cars primarily, exited that, and a few other businesses. So mostly underwriting kind of businesses. Really, around 2012 is where the story starts for where we are today. It's around 2011, 2012, in my day jobs, where we're doing insurance and finance, I started to see vendors come to me with really intriguing new products where it seemed almost too good to be true. For the time, I wasn't aware of what was going on so much in AI development and in technology in general. I wasn't following a lot of Silicon Valley at the time. I was focused on attending, insurance and finance conferences in my own little world, and been out of that side for so long. And suddenly I have vendors coming to us with some really innovative products where they can do what seemed like magic. They can say, take a claims database of unstructured notes and give you this amazing insights on tying all these pieces together and saying, hey, this attorney's been involved in, you have notes about this guy and you have this address showing up all over the place and all these kind of things. Here's some red flags. And it's like, wow, that's pretty cool. How do you do that? And I started really getting into excited about fintech and insurtech and through that AI, it's like, wow, AI today is actually real. And it's the kind of work I wanted to do 25 years ago when I was in school, but couldn't. It just wasn't there. And like, this is interesting. So I kind of went all in on that. I started attending all the conferences and around that industry, going up to Silicon Valley a lot, going to the Bay Area, attending all kinds of events and conferences, talking to funds, talking to founders of these startups that are doing this, and started doing some angel investing in that space and got really excited, wanted to build something in that area. And it's actually really what got me to get out of insurance and finance. My businesses were doing great, but they were bigger and the more I spend time away from them attending technology conferences and doing some angel investing and talking to these smart, geniuses inventing the future, the more I was excited about that, the less I was excited to come back to my day job, and eventually got investment bankers and got out of all my businesses. And so I could focus full time on angel investing in tech. So that's really how I got into angel investing in tech. By 2014, I was almost full time investing in tech. And spent quite a few years doing that. Eventually in 2019, a partner and I started a small fund so we can have, others can co-invest with us. I can write bigger checks and have a little more formal process around that. And that's kind of where we are today. I still have a diverse portfolio personally. And we also manage a small fund, which is Emerging Ventures Capital, which gives me structure to invest. Our thesis at the fund is investing in seed stage B2B tech startups that are using technologies to solve business challenges. And we currently only invest in US and Canada based startups within the fund. My personal mandate can be a little broader and I can experiment. But when it comes to the fund, it took us a little bit of time to kind of figure out exactly what we are, where we focus, but that's where we are today.
That's awesome, David. So, I went through your LinkedIn. I saw that you were part of Kemper and United Alliance a while back. And I actually we have somewhat similar paths there. I was in the Navy, and so I was operating, I was a nuclear power plant operator. We had to learn math, and I was really good at math and science and technology, but I ended up in the financial services world working for a company called Hartford Steam Boiler Inspection Insurance Company, which, if you've been in insurance, you probably knew of that company. We bought out the boiler division, property casualty piece of Kemper somewhere around, I think it was 2014-ish, give or take. I can't exactly remember. Maybe it was a little bit earlier. So I'm familiar with Kemper and whatnot. And I was the guy that was out there. I lived in the Silicon Valley, and so I got to see all these startups. I was just wondering, man, when is our company going to figure it out and catch up? And same kind of thing. I started seeing all these incredible opportunities. And for me, I was that squeaky wheel that got the grease. So eventually we started looking at that. I started working with some of our corporate venture team and helping out. So our paths might have crossed at some point in the past as well. So it's kind of cool to see that. And I think that your insights, and a lot of people don't realize this, right? About the financial markets, the insurance industry, and fintech and insurtech, how much they really are starting to rely a lot more on AI. And like you were saying, the early folks of AI, we would have these databases and spreadsheets decades old, right? And they were in Lotus 1, 2, 3 if they were even in a database to begin with. A lot of the times they were just pictures of PDFs that or pictures of somebody's notebook from years and years ago. And so I remember some of the first companies we started investing in and looking at were these early AI companies and machine learning and data and analytics companies that were essentially trying to uncode, if you will, all of this unstructured data so that we could turn it into actionable information. So very interesting world that we live in, isn't it?
Yeah.
Wonderful. So, you mentioned that you invested in over 500 different startups in the tech space throughout your career. And that's pretty prolific. A lot of folks can't claim even investing over 5 startups, let alone 500. So what do you feel was the key to your ability, capital aside? Of course, you need capital before you can even become an angel investor. But even a lot of folks that have capital, they can't figure out how to make a decision and invest in companies, let alone that many. So what do you feel was one of your keys to success in finding companies that you wanted to invest in?
Good question. And where I am today is different. Where it is a chicken and egg kind of thing. You have to be around the industry long enough to have seen enough and to have enough of a network to get all the deal flow. So it is a chicken and an egg. I would say I spent some time initially just attending conferences and getting to learn the ecosystem before I started investing. So for quite a while, I was mostly, the investment kind of came later. It was the excitement about the tech and where it is that came first. I was initially thinking that I would actually, start something in that field. I would start some kind of insurtech or, basically have controlling interest of some startup in that space without necessarily being a venture-backed startup. So I wasn't thinking venture capital or angel investing. It wasn't in my mind. I just wanted to learn the space. So that was what helped me not be frustrated. And the deal flow kind of started to come on its own afterwards. Particularly for me, the catalyst to get into angel investing was first finding the accelerator program. So as I was going up to the Bay Area and attending conferences, I started to learn about the ecosystem of the accelerators that are up there. And, that's before COVID. So before, all the demo days were in person. And I started attending a lot of demo days. And obviously those are pitches of startups. And from there, you get invited to you get on these lists of all these different pitch events. So you can spend your whole life, every day you can be attending several pitch events from different organizations. There's a lot of great programs out there between the famous for-profit accelerators like the Y Combinators, the 500 Startups, the Techstar programs, all those. Then there's various corporate hybrid, government hybrid programs, semi-nonprofit kind of programs all over the place. Like down here in LA, we have LACY, Los Angeles Clean Tech Incubator, great program, a bunch of other programs. So I can literally be out every day attending events. And for a while, I was doing a lot of that. I was, every evening somewhere. And then COVID hits, which is fast forward quite a bit later, but then everything goes virtual. After a few months of people panicking and shutting down, they kind of all went virtual. Now, some things on my bucket list that I couldn't attend before that I would say, okay, maybe someday I'll go to Boston and do, the MITs and the Harvard. There's all these other angel groups / accelerator programs / whatever from different universities that I wanted to go attend. Because before I would do UCLA, I would do USC, I would do whatever Caltech Angels, I would do all the local stuff. And some remote and a lot of Bay Area. But then COVID hit and you can really attend everything globally. And for a while I was on multiple events per day. So that really expanded it. And that's kind of where the fun came from. Because by then I realized okay, we have a global reach and we can see everything. But my advice to those who want to get into angel investing, you want to dip your toe in angel investing and don't know where to start, is find an angel group. There is over 300 angel groups throughout the country that are legitimate angel groups that are nonprofit organizations where you pay dues you have to be an accredited investor, and you apply and you pay your dues and you become a member of this small group. And some might be only 20, 30 members. The bigger city ones often have over 100 members. I've been a member of Tech Coast Angels, the Los Angeles chapter for many years. Now, for the last 6-7 years, a very active member, and I'm on the board of Pasadena Angels because I'm living out in the Pasadena area. And we have approximately 100 members at any time. Great group of people. What I've learned, though, by representing Pasadena Angels a few years ago on there's a national association called the Angel Capital Association, ACA. Mm-hmm. They're a nonprofit as well, and they're in a sense an association of associations. So groups like the Pasadena Angels are members of the ACA. It's another membership organization. And by attending the national conventions they have once a year, I realized that there's over 300. I thought, okay, there's a few of these groups here and there. There's actually over 300 angel groups that are just members of ACA. There's probably more that are not members. So there's a very large network out there. Any city you live in, and there's also several virtual groups. Not all of them have physical. Even Pasadena Angels now has hybrid meetings after COVID where they're in person and simulcast to Zoom at the same time. But so it's easier than ever to find an angel group where you resonate with the members and their thesis and what they do. And it's often possible to kind of sit in on the meeting, to asked to be a guest at a meeting to see if you like the people and like the format and like what they do before you apply for membership. So I would highly recommend joining an angel group, and then the education is there. They will teach you how to invest. And first of all, you're part of a group, so it's a group effort. They screen, there's often a screening committee. You screen startups, like Pasadena Angels gets over 50 applications a month from startups. And then I'm on the screening committee. We filter that. And eventually, throughout the process, 2 make it to our breakfast meeting out of approximately 50 each month. We filter it down to 2. There's 5 or 6 that make it to the final screening meeting the week before, and there's 20 to 30 that log in for that screening meeting, and they vote on which 2 will make it to breakfast. And then those 2 are presented. And then if there's enough interest from the group, we form a due diligence committee that is going to work on that deal with the founders. So you can passively sit back and watch, or you can actively get involved and try. And either way, at the end, it all presents back to all the members, and anyone who's interested, after all the work's been done, can write a check or not write a check. So doing this as part of a group is the least intimidating and best way to get over the learning curve and to avoid the chicken and the egg of the deal flow, because these groups have been around for a long time. Like Pasadena Angels is over 25 years, and some other groups have been around even longer. So they have the reputation, they have the deal flow, their name's out there. Founders know how to find them and apply to them. We're on all kinds of lists everywhere. And so the deal flow is there. Now you can see hundreds of deals and get a feel for what's a good startup, what's not, what you like, what you don't like, why, what other people liked and didn't like about each startup, why some deals fell apart, and so forth, as part of a group, and kind of benefit from the learning curve of others, benefit from other people's failures, and not have to learn the hard way, not have to make all the mistakes. I made a lot of mistakes in the early days. When you first start seeing pitch events, everything seems exciting. Everyone seems so smart. They all seem so enthusiastic about what they're building, and you can't help yourself but wanting to write them a check. It's like, oh, this is amazing. And, until you see several hundred more in the same area, and then you realize, that's not so amazing. Yeah, that's cool, but I've seen 10 other startups doing the exact same thing, and they're doing it much better and faster than you are. So you get a little sitting. After a while, you have much better filter. And yes, they're all smart. They're all amazingly enthusiastic and about what they're building, and feels like they're moving really fast compared, say, to the corporate world we come from. But compared to their peers, they're not always the best. And that's where it takes experience. You have to see hundreds and hundreds and hundreds of them, each doing the same kind of thing, to then say, this guy's really special. I've seen 20 startups solving this kind of problem, and yet you are doing it better, faster, smarter than the rest. It stands out. Or where in most cases, I've seen others doing it better. I'm not going to write you a check because it's a competitive space, and you're not the one that's going to win, in my opinion. You're smart. Yeah, you have a good idea. Yeah, you're doing something interesting, but I've seen others doing it better. I might not straight out say that to the founder. I might just say, yeah, that's great. And a lot of times I straight out say, I see, say 300 deals a month. I'm going to invest in 1 or 2 per quarter. It's about where we are now. Our pace, our cadence at the fund is about 1 or 2 deals per quarter. And I see in that time probably 1,000 deals. So, it's just, a lot of times I'll tell a founder straight out, what you're doing is great. There's nothing wrong with it. It's just, I know it's not going to make the cut because I'm going to do 1 or 2 deals this quarter, and you're not it. It's just, I've seen more exciting things and more interesting to me. I can't tell you if there's anything. We say, well, what's wrong? What can I do different? And a lot of times it's not. Yes, 95% of the time, I can rule out a startup for not being on thesis, being too early, moving too slow, whatever. But then within the 5% that are pretty good deals, then it's a matter of is this something really, really exciting? And my measure to myself is, if I was going to go all in on this startup, and I was going to be this guy's partner, in a sense, get married to the startup and have to, be involved in it for the next 10 years. Is this the one? If I had to choose one, is this it? Could I be excited to work on this for 10 years with this team? It has to pass that test. And that's a tough test. It's if I was going to go all in, is this something I would be happy? Actually, it's think about all day, every day if I had to. And if the answer is no to that, then I probably shouldn't write a check.
Before continuing, please subscribe and share this video to help us reach more people and stay notified of our latest releases. Now, let's continue watching and learning.
Yeah, absolutely. So what does get you excited right now? Like you said, you're seeing over 1,000 deals a quarter, which, it's a phenomenal amount. And anyone who's professional and serious about this, that's what they got to be doing. We agree. So what gets you excited after seeing that many? It's hard to get excited about a lot of things.
Yeah, execution. People that get shit done.
Isn't that funny? I want you to just pause for a second. think back to your early days of investing, because I had the scene. I was so excited about all these incredible innovations and great ideas. It's and now I tell, I was speaking on stage, and I tell folks when they're raising capital, ideas are still a dime a dozen because there's so many ideas. And just because you have a great one and, you haven't been out there and seeing 1,000 different ideas every single quarter, they think that there's the best one. And the same thing on the angel side. They think it's the best one. So I love that you just said that.
Yeah. Yeah. At the end of the day, there's very few truly unique things. Sometimes there is, and I don't do life sciences. I'm not smart enough. I don't, I know enterprise software. I know a lot of things. I don't know life sciences. So I don't do biotech. I don't do medical devices. It's actually another beauty of the angel groups where you'll have people with those backgrounds that can do. So I have done deals in that space through angel groups when I have the experts in the room that can help vet the deal. But that's another aside. But in general, the ideas are not unique. They're anything out there, like let's say right now, generative AI is obviously the hottest new topic. Everyone's doing it. And they're doing it for every little niche. They're applying it everywhere. So you'll see every day like 10 startups each doing something. They're like, oh, we're revolutionizing law practices. It's like, no, you're not. You're applying generative AI to that niche to one little aspect of law in one way. And I saw 10 others last week doing something similar. Some are doing a little different.
Not crazy.
But you're doing something, and there's 10 other people doing the exact same thing just that I saw, and there's probably another 100 that I didn't see. So it really all comes down to execution, because other people are going to be doing the same thing, and it's not how good is your idea. Your ideas can change. You're going to pivot. Almost every startup eventually pivots. Some change, maybe a complete pivot, maybe a change in business model or some other, features and so forth. But at the end of the day is, can you build a product? Can you sell a product? Can you get the right customers to pay for a product? And, can you do it efficiently and quickly? Efficiently in time and money, and people, and resources in general. And that's what gets me excited. When I see someone who moves fast, they no excuses. They just get stuff done. They'll figure it out. They're the guys who will survive. They're the guys who will pivot. They'll try everything and eventually figure something out and make it work.
So that brings me, and there's a lot of questions I could have for that, but we only have so many hours of the day. When you say something like that, I feel like Gino Wickman's book Traction is as imperative in the startup system as it is in the operating business world. In so much as you have these people who have amazing ideas, and some of them are truly innovative and world changing in some cases, but it's only if they can pull it off, right?
Okay.
And so one of the challenges I see with a lot of entrepreneurs is the shiny object syndrome, right? They're so excited about this idea today, and then this idea the next day, and this idea the next day, and they don't stay the course long enough to see it through, and then get to a point where it's making a reasonable pivot, right? So, like you said, execution is key. So, what's the flip side of that? What are some red flags that you see when they're pitching or with their idea? Let's just say, just take the 5% that pass your first test. What are some of those red flags you end up seeing?
So if they've, I saw one over the weekend where great repeat, solid team, good product for a good industry. It all makes sense. They had a pre-seed where they raised a year ago. They raised $3.6 million. Now they're going out to raise a seed round when they only launched and they have 8 early customers, and they're calling it now their seed round. And it's like, wait a minute, how did they burn through $3.6 million in 1 year building an MVP? That's out of the norm. Normally, early stage startups like that are building MVP are burning like roughly $50,000 a month, not burning $300,000 a month. So right. I saw I communicated with this person. We were chatting, got the full pitch, and then declined having a meeting with them to follow up because that was a big red flag for me. As someone who burnt $3.6 million in 1 year building an MVP is just not of interest to me. That's against my idea. Yes, they executed on building MVP, but they spent way too much. So however they're thinking about their business is not in alignment with the efficiency model that I like. That was a big red flag for me. Most of the red flags is just thinking that everything's going to be easy, honestly. When you see these pitch decks that are unrealistic, and they're right at that early launch, beta stage, and they have this forecast where basically they're going to own the market in 2 years or something. There's this exponential hockey stick growth. And you can tell from the way they're presenting it that their mindset is that the sales are easy, and they're not. And especially when it comes to enterprise sales, it's not going to work the way you think it works. And you're delusional. And I don't want to meet with them because I don't want to have to explain that to them. So I just decline those. It's like, let them figure it out the hard way. And I just tell them to come back to me when they have much more traction. Also having some big logos initially, like I learned this the hard way. I would get excited when a startup, especially on the enterprise side, would have some big logos of a type of business that I know is hard to get, like say a bank as a customer. If they're doing some kind of new AI credit scoring models for banks, for underwriting, for loans, it's something I know a little bit about. And it's like, okay, whatever, just another, one of the many. But then they'll have these great logos. It's like, and I'll say, okay, that pilot, I have, let's say, for example, I have Citibank, I have whatever. They'll have a few big logos out there. It's like, wow, that's amazing. Now I go on LinkedIn, do a little research. Guess what? The 2 customers they have are the former employers of both of the co-founders.
Right.
It's like, okay, that doesn't count. That's founder-led. That's your warm intro. It's like me having as LPs in my fund only my friends, which in essence it was. And then you go out, try to get people who don't know you. It doesn't work. It's a completely different game. I need a repeatable, scalable sales process, or this is not going to be venture backable. You're not going to have the growth. The sales are not going to work.
I just have to chime in here. That is one of the biggest things that we see, and we tell all these companies all the time is they think that money's going to solve the problem. And the thing is just like you said, if they don't know how to sell their product or their service or their technology or anything to an actual customer, a scalable, repeatable, dependable sales and marketing system is vital to grow any company. I mean, any company. I haven't seen a company that can do it without it. So there's plenty
I won't invest until they figured that out. That's really what it comes down to today. If they just have a pilot here and a pilot there, and they think all the customers they have this idea that it's gonna. So the red flag to me is them thinking. The short answer is the red flag. One of the biggest red flags that comes up over and over is the founders not having a sales background and yet thinking that the product will solve everything and that the sales come automatically. Because it's going to be a hard lesson for them to realize how difficult it is to really get in and make sales to enterprise. Procurement process is not simple. And on the flip side, what gets me excited is those who cracked it. And I'm super impressed sometimes how early some of those really cracked that. And that just gets me completely excited when I'll talk to them and I'm completely ready for them to say, oh, no, that's just a pilot and that's just this and that's just that. When they tell me, it's like, oh, no, we have all 5 of those customers, all 5 of them on long-term contracts. And we have a pipeline here of 15 more. And here's where we are with each one of them. It's like, oh, my God, I don't know how you did that. Why these companies would trust this startup with such a, delicate part of their operations. But if you did that, I'm in. Because that's magic. I couldn't do that. I couldn't go and get the biggest corporations in the US or in the globe to buy us. I wouldn't even get through the door. And yet you got in the door over and over and over to companies you don't know through cold outreach. And you did it multiple times. It's not one fluke, but you've done it multiple times. And you have a funnel where you're continuing this process. I'm in. I want to be your partner.
That's a really good example.
And I don't care what your product is. I don't care what it is. You're obviously solving, and you're scratching an itch to these corporations. You're solving something that they need, and they're willing to buy it from you.
Yeah, that's a pretty impressive thing. So we only have a few minutes left here, David. But one of the things that I think is really important for people to understand right now. The world has shifted in the last decade, 2 decades when it comes to angel investing versus venture capital and the amount of money and liquidity there is in the world right now. And you've been an angel investor and you have an emerging venture capital fund. So what's the difference that you're seeing right now? Like, what are the different stages? What are the different check sizes that people are writing? And, if somebody's interested in, being an angel, what should they expect to be forking out? And should they do it? You already mentioned they should go through a group, and if they're inexperienced. But what's the difference between investing in a fund like yours versus a direct investment into a company? I know it's a loaded question. There's a lot there, but I'd love to have your insight.
So, if someone's out there that just wants passive access to this investment class, then become an LP in a fund.
Right.
Write a check, because the funds will do all the work. And they'll probably do it better than you can unless you're doing it full time. It is tough to have the deal flow, to see the best deals, and then to diligence them and select them. So if you really just want passive access and you want, the best chance of having a decent return in this space, write checks to a few different funds that do a few different stages or geographies or asset or types of startups, and you'll get some diverse access to this asset class. If you want to be an angel investor, as in you want to actually spend some time, you want to meet startups, you want to follow them, you want to be somehow in this ecosystem, then definitely start out by joining an angel group. That's the quickest way over the learning curve, and to get into the space. And as far as check size, if you're at a pre-seed round, startups are usually raising roughly $1 million. It might be $500,000, might be $1.5 million. That's typical size, at something like a $5 to $10 million valuation. At the seed stage, they're probably raising $2 to $4 million at something like, from a $10 to $20 million valuation. And sometimes less, sometimes more, but, averaging somewhere in the teens. That's the total raise. Our fund writes checks from $100,000 to $500,000 to these startups. As an angel investor, my typical check is like $10,000. A lot of times $5,000 even, sometimes $25,000. It's more like $5,000 to $25,000. I've written some $50,000 angel checks, and I've written some $5,000 angel checks. Typically, it's around $10,000 to $25,000 as an angel investor. And if it's but then they're coming in to a group and collecting those, and whether they roll them up into an SPV to have one entry on the cap table, or where they take individual angels directly on the cap table. Personally, I prefer being on the cap table directly, but I've gone into quite a few SPVs, especially in the early days. I'm in several hundred SPVs too, but and really it's just a technical way of not clearing the cap table. They'll collect a whole bunch of investments into one LLC, one special purpose vehicle that they then becomes the entry on the cap table, becomes the shareholder, and there's one representative of that group, whether it's through an angel group or through directly where they're doing a roll-up, like AngelList provides roll-up vehicles and so forth. So there's a lot of technology that makes it easy for a lot of people to write small checks. It's not crowdfunding per se. That's another whole thing. And it's another way, by the way, to learn the space. As individuals, whether you're accredited or not, you can find all the crowdfunding platforms out there. There's several. I don't want to endorse any particular one. There's several legitimate crowdfunding platforms. And you can see a lot of deals that way of just if you want to get sensitized to what kind of startups are raising money and what it looks like, what a pitch deck looks like, you can spend your free time looking on the line through online pitch of both. There's recorded pitches and pitch decks from the crowdfunding space. That's another place to learn. But yeah, you can be an angel investor writing a lot of $10,000 checks, or just listening in and not writing checks. And until you're ready, and when you're ready, you write. That's at your own pace. You can write 1 check a year. You can write no checks. You can write 10 checks a month. It's really up to you.
I love it. Yeah, I really appreciate that breakdown, because I think a lot of folks are feeling like, oh man, I don't know if I can write a $50,000 or $100,000 check. And they tend to forget that there's these different stages, right? There's the pre-seed, we call it the friends, family, and fools sometimes, right? The friends and family round, and then the people are just going to, hope and prayer, and I hope you guys figure it out. And then you get to the pre-seed, and then you have the seed round, then you have, we call it even late seed, because you have some people who are like, oh, we can't do our Series A yet. We're not quite to a, millionaire or whatever the number is. So we're going to do a late seed round. I feel like we need to come up with new nomenclature for these different rounds, because they've been broken down into so many different tranches over the years. But I really appreciate that breakdown. Well, David, we are at time here. I really appreciate it. Why don't you let people know how they can find you, where they can find out a little bit more about Emerging Venture, and maybe connect with you.
Sure. I'm easy to find everywhere online. Simplest is maybe our corporate website, emerging.vc. So it's Emerging Ventures Capital, where emerging.vc is the website. And from there's links to my personal blog site, which is mandel.blog or davidmandel.blog. And my LinkedIn and everything else, my Twitter, it's all there.
Awesome. Thanks so much, David. I really appreciate it. Appreciate your time and your insight today. And I know that people are going to go check you out and look you up online. So we'll make sure we have all of that information inside the show notes.
Right.
So for those of you out there listening, watching, thanks so much for being here again. This has been the Angels, Exits, and Acquisitions podcast by Angel Investors Network. And we've been here with David Mandel from Emerging Venture Capital. David, thanks so much.
Thank you, Jeff.